China.
China.
China. China.
China.
China.
China.
China.
China has a massive debt problem.
Unrest is growing in China. Fresh protests have broken out in major cities with hundreds rallying, chanting, "We want freedom."
China's debt crisis is spiraling out of control, threatening to shatter the global economy. The CCP's hidden financial bombs are ticking, and no one knows which will explode first. What happens next could rewrite the world's economic future, and it's happening right now. China's debt crisis in 2025. China's debt crisis in 2025 represents a critical juncture for the nation's economy. Years of rapid credit expansion, particularly following the 2008 financial crisis, have left the country with alarming levels of debt relative to GDP. Even with attempts to stimulate growth with increased borrowing, economic signals such as sluggish consumption and declining investment reveal deep vulnerabilities. The government has launched a substantial debt reduction plan, approximately 10 trillion yuan, aiming to stabilize the situation. Local governments and state-owned enterprises, also known as SOEs, have accumulated most of this debt, creating systemic risks. If unresolved, this crisis threatens to derail China's economic growth targets for 2025 and beyond, potentially triggering broader financial instability domestically and internationally. The stakes are high as China's economy is closely interlinked with global markets, so what happens in 2025 could have ripple effects worldwide. The scale of CCP's hidden and official debt. The Chinese Communist Party's debt includes both official government liabilities and a vast web of hidden debts, especially through off-balance sheet entities. Official government debt has surged to over 60% of GDP, while combining all obligations including local government debt and state enterprises, debt levels exceed 120% of GDP. A significant proportion is hidden in local government financing vehicles, also known as LGFVs, which were created to bypass borrowing limits, causing transparency issues. This shadow borrowing has ballooned, leading to augmented debt estimates as high as 312% of GDP in the non-financial sectors. The opacity and scale of this debt increase the risk of defaults and complicate monetary policy, with both domestic markets and international observers concerned about potential contagion effects. Role of local government debt and finance vehicles. Local governments in China have relied heavily on LGFVs to fund infrastructure and development projects, circumventing restrictions on official borrowing. These entities borrow from banks and insurers, creating massive off-balance sheet debt. LGFVs have been key drivers of local economic growth, but also a source of escalating fiscal risk. Since revenues generated from land sales, a primary income source for local governments, have dwindled due to the real estate slump, LGFVs face considerable repayment pressures. This has forced recent government policy to convert hidden LGFV debt into formal bonds, aiming to impose greater oversight. However, the transition is slow, and many projects financed by LGFVs have not generated expected returns, tightening financial strains at the local level. Impact of excessive money printing and monetary expansion. China has aggressively expanded its money supply in recent years to stimulate the economy and manage debt servicing costs. The M2 money supply growth has doubled compared to real GDP growth, indicating considerable liquidity infusion. However, this massive monetary expansion risks fueling asset bubbles without translating into meaningful price inflation. In fact, China has faced periods of deflationary pressure, adding to economic stress. Excess liquidity has also distorted credit markets, enabled risky lending practices, and crowded out productive investments. While monetary easing aims to stabilize growth, unchecked money printing strains long-term financial stability and undermines confidence in the yuan's value, complicating China's efforts to balance growth and inflation. The real estate bubble and its threat to the economy. China's real estate sector, long a pillar of economic growth, now represents a precarious bubble fueled by speculative investment and massive borrowing. Property prices have been on a volatile downward trend as debt defaults by major developers have shaken market confidence. The slowdown affects not just real estate firms, but also local governments that rely on land sales for revenue, further pressuring their fiscal health. Unfinished projects and falling demand contribute to shrinking household wealth and rising economic uncertainty. This bubble burst threatens widespread job losses and reduced household consumption, undermining broader economic stability. The ripple effects extend beyond real estate, risking a credit crunch that could freeze up broader financial markets. Failed infrastructure and money-losing projects. Ambitious infrastructure projects, including extensive high-speed rail networks, have often been financed through heavy borrowing by LGFVs. Many of these ventures now operate at losses or underutilization, failing to generate expected economic returns. These money-losing projects exacerbate local debt burdens and limit fiscal capacity for critical services. The strategy to boost growth via infrastructure investment has backfired in many regions, contributing to inefficient capital allocation and increasing financial strain on local governments. As debt servicing consumes more resources, the ability to invest in productive sectors diminishes, risking a cycle of stagnation and indebtedness with long-term economic consequences. Rising youth unemployment and economic slowdown indicators. Youth unemployment in China remains a significant concern in 2025, hovering around 14.5% for those aged 16 to 24 outside academic settings, according to recent government data. This high rate reflects structural challenges in the job market, especially in urban areas where millions of recent graduates join the workforce annually. Alongside youth unemployment, key slowdown indicators include decreased industrial output, falling export demand, and weakening consumer spending. These trends suggest broader economic fragility as domestic consumption struggles to offset external pressures like trade disputes. The government has launched measures to stabilize employment, including expanded loan programs and unemployment insurance benefits for businesses. Still, job creation remains below expectations, impacting social stability and long-term growth. The combination of stalled hiring and economic trend deceleration underscores the urgency for sustainable reforms to prevent lasting damage to China's human capital and economic momentum. Government's fiscal measures and increased borrowing in 2025. To counter economic headwinds in 2025, Beijing has ramped up fiscal interventions, significantly increasing government borrowing to fund stimulus packages and social programs. The central government has expanded special loan support aimed at preserving employment and boosting consumption. Local governments, facing revenue shortfalls from declining land sales and slowing economic activity, have also increased bond issuances to bridge fiscal gaps. Additionally, enhanced fiscal policies include raising corporate unemployment insurance refunds and temporarily suspending certain social insurance payments to ease burdens on enterprises. This aggressive borrowing spree reflects the state's balancing act, spurring growth while managing mounting debt risks. However, elevated borrowing could exacerbate existing financial vulnerabilities, especially if economic growth fails to accelerate as targeted. The government's approach indicates a shift toward more active deficit spending as a tool to sustain the economy through challenging domestic and global conditions. Global implications of China's debt crisis and economic instability. China's unfolding debt crisis is not just a domestic issue. It poses far-reaching consequences globally. As the world's second-largest economy, China's financial instability threatens to disrupt international supply chains, commodity markets, and investment flows. Foreign companies tied to Chinese markets face heightened risks of losses tied to credit defaults and weakened consumer spending. Emerging markets dependent on Chinese demand and financing may experience spillover effects as China tightens its belt. Moreover, the yuan's stability is under pressure, influencing global currency markets and potentially prompting shifts in foreign exchange reserves. If China's debt crisis deepens, it could trigger a global liquidity squeeze and dampen global growth prospects. International monetary institutions and trading partners are closely monitoring Beijing's policy responses, knowing any misstep could cascade into broader economic turbulence beyond China's borders. China's shift from lender to debt collector in developing countries. China's international financial role is evolving sharply in 2025, from that of a generous lender to more of a strict debt collector, especially in developing countries. Over the past decade, China extended massive loans through initiatives like the Belt and Road, funding infrastructure projects worldwide. However, many debtor nations now struggle with repayment, prompting Beijing to focus on recovering funds and restructuring debt agreements. This shift reflects China's growing caution as it protects its own fragile economic stability amid domestic debt concerns. While China still seeks strategic influence through overseas investments, its tougher stance on debt collection signals a recalibration balancing geopolitical ambitions with financial prudence. This transition affects development financing globally, compelling recipient countries to reassess their economic partnerships and fiscal dependence on Beijing. The CCP's political challenges and economic policy dilemmas. Facing this severe debt crisis, the Chinese Communist Party, also known as CCP, confronts profound political and economic dilemmas in 2025. Maintaining economic growth targets while controlling ballooning debt presents a policy paradox. Aggressive stimulus risks worsening financial instability, while austerity could stifle growth and fuel social unrest. The CCP must also manage rising public frustration over youth unemployment and inequalities exacerbated by economic slowdowns. Politically, the leadership seeks to reinforce legitimacy by projecting strength and maintaining stability, yet must navigate competing interests among state-owned enterprises, local governments, and the private sector. Balancing reform pressure with the imperative to prevent systemic crises complicates decision-making. The party's capacity to implement effective policy without triggering broader unrest or loss of confidence remains critical during this fraught period. What happens next for China and the world hangs in the balance. As the CCP wrestles with this looming crisis, every nation and market will be watching. Will this debt storm unleash a global shock or force a radical new chapter for China? Stay tuned because the fallout is just beginning. Thanks for watching.